What's going on, you guys? Welcome back to my series here on investing in the stock market for beginners. And in this video, we're going to be talking about some stock market lingo or some industry terminology that you should be familiar with as an investor. Now, there are a lot of different words out there that are used, and it's kind of like a way for them to separate themselves from other people out there, I think, because people will purposefully use different trade lingo that many people don't understand. I don't know why people do this. I try to keep things simple, but I'm going to show you guys some of the basic terms that you should be familiar with today in this video. Now, the very next thing I want you guys to do after you watch this video is jump over and take my free course on how to find a great investment. I've had over 1,500 people go through this free course. It's under 1 hour long, and it will be a great foundation for you if you're looking to learn about investing in the stock market, and the link for that is in the description below. So make sure you guys take that free course after you watch this video. It's completely free, and it is my gift to you to thank you for supporting my channel here on YouTube. But first, we're going to start by talking about some trading terminology that you should be familiar with, and we'll start with some very simple basics here. When you buy something or when you buy a stock, what you're doing is you are taking a position in a company, and then when you sell that stock, you are going to be getting rid of shares to profit or cut losses. Now, I didn't talk about what a stock is because we already covered that in the very first video, but basically, remember, a stock is an ownership asset in a real company. So when you're buying a stock, you are taking a position in that company, and then when you're selling it, you're getting rid of that position, and hopefully it's for a profit, but maybe you're cutting losses instead. And a position is an ownership stake in a company through a stock investment. Now, when you're looking at a quotation page for a stock, you will see there will be a quote price, and the quote price we'll mention is the latest price for a stock at that current point in time. That's lower down on the list, but it's worth mentioning now. But you'll have a quote price, a bid price, and an ask price. So the bid price is what you are willing to buy for, or what the market is willing to buy for at this current point in time. So all of the buyers lining up to buy shares of that stock, that is what they're willing to pay. And then the ask is what the sellers are willing to sell for. So those who are looking to sell the stock, this is what they're asking for or what they're looking to sell. And there's always a difference between the bid price and the ask price, and that is known as the spread, and that depends on the liquidity of that actual stock. If it is a highly liquid stock, you're going to see less spread, and if the stock is not trading with great volume, it's going to be a much greater spread. Now, I probably just mentioned two words there that you're not familiar with. So first of all, liquidity is how easily you can get in and out of a stock, and liquidity ties in directly with volume, because stocks that trade at a higher volume, or the number of shares that change hands, higher volume means better liquidity, and so higher volume stocks, it's more easy to change hands, it's more easy to buy and sell those stocks because so many people are out there actively buying and selling them, and as a result, the spread, or the difference between what people are willing to buy and sell for, is going to be much tighter. And really, guys, this isn't anything you need to know, but it's just worth mentioning because a lot of people see these terms on a quotation page for a stock and they have absolutely no idea what they mean, but now you have a basic understanding. Now, when you're going long, that means that you are betting that the stock price will increase over time. So you're buying a position in that stock, and that's when you say, I'm long a position, or I'm long Google, because I believe that stock is going to increase in price over time. Now, when you actually buy shares of a stock, you're going to go through your broker, and your broker is basically your stock dealer, or a person who buys or sells shares on your behalf. It's kind of like a car dealer. You can't go out there and buy a Ford truck by calling up the Ford Motor Company. You're going to have to go through a Ford dealer, and that's basically what a broker is. They're your stock dealer. Instead of buying a car, though, you're buying or selling stocks. Now, the actual investments or shares of a stock are changing hands on an exchange. Two common ones are the New York Stock Exchange and the NASDAQ, and that is where your broker is going to be executing that order. Now, to mention that, execution is when a buy or sell order is completed. So if you have a buy order on a particular stock, you're going to go through your broker, maybe it's your online discount broker, and they're going to execute that order for you on the exchange, and you'll get a confirmation once that has taken place and your order has been executed. Now, we already mentioned what the quote was in volume, but we'll finally mention what the symbol is. That's just an alphabetic marker used to identify a stock. So Amazon stock is under the symbol AMZN. So if you were trying to trade Amazon stock, you would have to use that symbol. It's just an identification marker. And then we will wrap up here with some market terminology. First of all, a bull market is when stock prices are expected to rise, and as a result, a bullish investor is betting that the price will rise and they're trying to capitalize on an upward price movement. Now, a bear market, on the other hand, is when stock prices are expected to fall, sell, and a bearish investor is betting that the price will fall. They're going to be short selling that stock, and short selling basically means they are betting against that stock. We're not going to explain that in this video. It's a little bit too complicated, but I've done other videos about that on my channel. Now, volatility is another word you will come across frequently. Volatility simply means how fast and frequently a stock moves up and down. Maybe you look at a company like Kimberly-Clark. It's a large blue chip stock. We'll talk about blue chip in a second here, but it's a large, well-established company. They've been around for a long time, so you're not going to see much volatility there. That stock's going to be relatively stable. But then think about a new emerging tech company. That's going to be a very volatile stock because there's going to be a lot more shares of that company changing hands, and as a result, there's going to be more upward and downward price movements within the trading day or over spans of time. That is what volatility is. And as a beginner, you want to be looking for investments with low volatility. Now, market capitalization is what the market thinks the company is worth. You calculate that by multiplying the outstanding shares by the price per share, and that gives you the market cap. Then the IPO is the initial public offering. That is when a private company offers shares to the public for the first time. They do this through an IPO. And if they're offering more shares to the public, it's done through a secondary offering. Now, blue chip, we mentioned blue chip a second ago. This is actually named after the blue chip in poker being the one with the most value. A blue chip stock is a large, well-established, and financially stable company. An ETF is an exchange-traded fund that tracks an underlying index like the S&P 500 or Dow Jones Industrial Average, but an index is actually just a group of companies. So the Dow Jones Industrial Average is a group of 30 well-established, financially stable companies, and you could invest in an ETF that tracks the Dow Jones Industrial Average. And then beta has to do with the volatility or the up and down price movements of a stock. It looks at the volatility of this investment compared to the overall volatility of the market. And if the beta is above 1, that means this investment is more volatile than the market, or it is susceptible to more upward and downward price movements than the overall market is. And so as a beginner, you want to be investing in stocks with a low beta or a beta below 1 because you don't want to have volatility within your portfolio until you have enough experience. And then we have a dividend. The dividend is a quarterly cash payment that is paid out to shareholders. It's not always quarterly, but frequently, in most cases, it's a quarterly payment. If you're a Disney stock investor, you know that it's not a quarterly payment. And then finally, a portfolio is just a collection of investments. But anyways, guys, that is some basic investment terminology you should be familiar with. If you get these terms down, you'll be in good shape, and you can just add to this as you learn more about investing. But I thank you guys for taking the time to watch this video, and I will see you in the next one. If you are interested in learning more about investing in the stock market, I've created a free course just for you. The link is in the description below. Here are a few other videos you might enjoy as well.